if you are a wrapper business that's built on top of one of the major LLMs, right now, the major LLMs are subsidizing almost every wrapper company. That model hasn't shifted yet. So we don't really know what's going to happen to the companies that have based their entire cost structure in what the world is today. But we don't know what that's going to look like in 6 months, 12 months, or 2 years from now. Software has mostly been secured by the fact that it was really hard to write code before. That's being democratized right now with AI and coding tools. For the last 10 to 15 years, if you saw a multiple $1,000,000 ARR business with gross retention of 90%, net retention over 110, growing at least 40% year over year, that company would have tons of funding options available to it. Now it's not so clear necessarily if that's enough. How solid and susceptible is that business and that retention to someone coming in and disrupting your customer base with AI, either from a new competitor or from your direct customers implementing AI into their own stack without you?
So what I'm hearing is the bar is ever higher in terms of capital for companies. So are you one GPT release away from being completely irrelevant? Josh Axler has deployed over $200 million in growth stage companies. He's the managing director at Flow Capital, a publicly traded alternative lender, and his job is to decide, usually within weeks, whether a founder's business is actually worth backing with real money. He's not a VC, he's not a banker. He sits in the gap between the two, funding the founders who've decided they'd rather keep their company than dilute it. Today, we're going to deep into lending, what the people writing the checks actually see when they look at your business, and why the $20 million exit might put more in your pocket than the $200 million one. Josh, welcome to the show.
Thanks for having me, Kristen.
So let's dive into what we've been talking about behind the scenes. Andreessen Horowitz just published a piece around that, arguing that AI is about to dissolve the one moat most software companies had been hiding behind: switching costs. So this is like when you have all your data, all your financial systems hooked up, all your integrations, it takes a lot of effort to switch. But when your AI agent can handle the migration, vendor lock-in stops working as your moat. But the one moat that actually survives in their perspective is brand. Because at the end of the day, agents still report to humans and humans still need to trust someone. So Josh, from your perspective, you've seen hundreds of founder cap tables and growth models a year from the venture debt side. When Andreessen comes out saying switching costs are dead in software and brand is the last real moat, does that match what you're actually seeing in the companies that are hitting your desk?
I think that might be a bit of an exaggeration today. I generally agree with that sentiment that the agents will be able to get in there. But as we stand right now, the human in the loop side of working with your agents and getting the agents set up, and for people to have that level of trust with agents getting into their data, I think we're still very early innings on that. No doubts that that capability is coming. I think there are some really fundamental questions about what the moats are in software. Specifically, software has mostly been secured by the fact that it was really hard to write code before. You needed the top talent.
Yeah.
It was really hard for small companies to attract top talent away from the largest companies. That's being democratized right now with AI and coding tools.
Let's unpack that a little bit, because code was very expensive. I built a tech company. I had to raise a lot of money to hire engineers. I'm not technical. Now we can vibe code, which is sort of write natural language to build software. Cool. But at the end of the day, as we talked about, there's very few people who have fully adopted this yet. So we're kind of at the early adopter phase of this cycle with agentic AI. So what do you see as the defensible moats in the kind of short term, midterm, and as we look ahead?
Yeah, so we tend to work with companies at the early growth stage. So they start to show some signs of product market fit. They have revenue, usually multiple millions of dollars of revenue. So we're not working necessarily with the companies that are still in the vibe coding idea phase. But what it is doing is it's empowering everyone within an organization. For example, on our team, we had our marketing person vibe code an AI agent to talk to our CRM to make it easier to log. We see CEOs that are empowered and really being able to actually talk the language of code with their engineers. They can come up with an idea, go through the initial mock-up of what that code might look like, and then send it to their engineering team and save weeks of the workflow. So a lot of things are moving faster. And what that means for companies is they may not necessarily need to budget for as much engineering talent. However, the flip side of that is you still need really high talent and great people to take it to the execution phase.
Well, and I'm curious too. So the people side is one thing, but also we talk about, like, if you're getting into this, there was Ivan, the CEO of Notion, talked last week about how He's not asking about ROI around this. He's basically saying like unlimited tokens. Now, this isn't a company that is scaling quickly, venture backed. Like, okay, not most companies can really say unlimited budget, but from a compute perspective too, are you seeing this sort of show up in fixed costs of companies as they scale beyond the human?
Yeah, well, what's interesting is I don't think people understand really where AI is going to land in the P&L. Like,
Right.
where does it
Right.
land in COGS? Where does it land as a fixed cost? What is your base layer amount of token usage or service providers? If you are a wrapper business that's built on top of one of the major LLMs, right now, the major LLMs are subsidizing almost every wrapper company because they seem to have infinite funding from the capital markets.
Interesting.
That model hasn't shifted yet. So we don't really know what's going to happen to the companies that have based their entire cost structure in what the world is today, but we don't know what that's going to look like in 6 months, 12 months, or, 2 years from now.
So interesting when you look at that. So, okay, we'll dive into the early side of this hype cycle where we are because it's still time to be seen. But those are some known unknowns for the future.
Yeah,
When it comes to
absolutely.
this whole headline of SaaS is dead, you see a bunch of companies come across your desk. What's your reaction to that?
I mean, I think there's some truth to it. I think that a lot of the rules of venture, as it relates to SaaS, are being questioned as AI
Right.
comes into the mix. As a financer of technology and SaaS companies, for the last 10 to 15 years, if you saw a multiple $1 million ARR business with gross retention of 90%, net retention over 110, growing at least 40% year over year, that company would have tons of funding options available to it. Now it's not so clear necessarily if that's enough, which is crazy to
Mm.
think. Fundamentally, that is an unbelievable business. What's interesting to funding companies now is what's the AI angle? How solid and susceptible is that business and that retention to someone coming in and disrupting your customer base with AI, either from a new
So interesting.
competitor or from your direct customers implementing AI into their own stack without you.
So are you one GBT release away from being completely irrelevant? Is a
Or
question that you're
simplify it,
asking.
is your product and company a feature or a real fundamental product and workflow that can't be replaced?
So what I'm hearing is the bar is ever higher in terms of capital for companies, even with those phenomenal traditional metrics like you talked about. Can you give me an example of some of the metrics that you would sort of say, hey, founder, this is what you really want to be hitting before you're ready for our kind of venture model? And by venture
Yeah,
model, I mean lending model.
yeah, venture debt. So, I mean, if a company came to me with with those metrics that I just presented, I'd be thrilled to talk about financing them. I think we look at certain metrics and then we also want to understand what those metrics mean for the business, like what's underlying in their business process, who are their end customers, what is the sales cycle. You talked about switching costs before. So a lot of those things factor into the numbers in and of themselves, but certainly growth rate is important. Things like capital efficiency. So how much are they spending on sales and marketing in order to acquire a new customer? How close are they to cash flow positive? Most of the companies we work with are still burning cash as they're investing into growth. And they should be because they're growing at a high rate and they can justify and get a high return on those growth dollars. But I think importantly, right now, a lot of the companies we work with, they want to get to that optionality point. So they could be profitable either today or very soon, but they're choosing to make investments in growth because they think that's the best way to increase enterprise value.
We talk a lot about optionality, and we mostly work with founders who do not have venture backing. And we talked a little bit about this too, is there's a trend that you're seeing related to seed strapping. Can
Mhm.
you define what that actually means, what that looks like, and sort of is this a recent thing? Has this
Yeah.
also been compacted by the fact that AI is making it less expensive for you to access and build code? What's your perspective?
Yeah, absolutely. I mean, seed strapping fundamentally is a founder or founding team raising a seed round, getting themselves to, that minimal viable product or to product market fit or a certain level of revenue where they feel like they can be a sustained company without needing any additional funding or looking at alternative sources of funding other than venture capital to continue their growth. So it's kind of
Right.
flipped the model. Historically, a lot of companies would say, go get revenue and then you might be eligible for, venture capital. And then you might continue to do lots of rounds to finance that growth. Now we're seeing tons of founders who are, raising a little bit of money to kind of get the team together, get in a salesperson, get someone to help them with marketing, get the team that they need to get themselves off the ground, and then really fill in the gap with their own profitability and no longer needing venture dollars to continue to scale.
What's different about a deck, do you think, in that example, than someone who is kind of continuously believing they need to be on the treadmill of raising continuous rounds? And I raised money. I went through the process. I was in SF doing 150 pitches to venture capitalists and many unsuccessfully. Like it was a crazy ride. But I was spending more time on that when I really should have just been selling my customers and expanding my enterprise revenue. Like it was a focus question. So I'm curious for you, what's the difference in sort of the strategy and the vision of a deck that is thinking more sustainably
Mhm.
about the build?
I think that the fundamental question is like how fast you want to go, and then
Yeah.
what does more capital really unlock for you. So you have to look at
Right.
the end market that you're in, how competitive it is, how well funded are your competition, and are they doing things fundamentally differently than you that if you don't have that capital, you won't be able to compete. Primarily, the companies we work with are not growing, 100% month over month. They're
Right.
typically in a 40 to 100% year over year. Unbelievable growth. We love working with these companies, but they may not necessarily be attractive to venture, which means if they go out to raise equity, it's going to be at a lower valuation. And so they're probably going to have to give up a lot of their company in order to do so. So
Yes.
it comes down to what they're trying to achieve with their company, what their goals are, and what capital really unlocks for them.
What is it about that makes them unattractive to traditional venture capital? Because that sounds like ridiculous growth when you're describing 40 to 100%. And
Right.
obviously, if it's small numbers, it can be wild. But I'm kind of curious what you see there.
Yeah, I mean, in the world we're living in right now, you have companies like Fixer and Lovable that have gone from, 0 to 100 million ARR in a year. So when you start
Crazy.
talking about going from a million to 1.5 million in a year, it just doesn't get certain investors excited.
But it's a great business. And this is where enter space for this and this idea of, hey, equity in the long run. And I didn't realize this when I was building my first company. It's very expensive, especially as the enterprise value of the firm goes up. And more founders aren't really thinking about enterprise value. Why do you think that is? That we don't think about that? Is it a lack of education about it? Because frankly, we went to business school together. I don't really
Yeah,
remember learning about enterprise value all that much from a founder perspective. What's
that's
your
right.
take?
Yeah, I think people don't recognize the cost of capital spectrum, and they don't realize that equity is the most expensive cost of capital that you can put out
Mm,
there because they think cost of capital, that means there has to be an interest rate to it. So if I'm not
right.
paying interest or I'm not paying a real cost of capital that comes out of my pocket every month, it doesn't cost me anything. They
Mm,
don't go to an end scenario where we get to an exit and they gave up 20% of their company. And that was 2 years ago. And so that 20 million over 2 years, that's pretty expensive money, no matter how much you got for it. So those are one things to consider. We really try to simplify it to our founders in this way. Most of our borrowers are looking to value themselves as a revenue multiple because they're not yet profitable. So it's kind of hard
yes.
to value negative EBITDA. But so very simply, as long as you're growing your sales, whatever your growth rate on sales is a good proxy for your cost of equity capital if you're trading at a revenue multiple. And that's before you get any revenue multiple expansion as you grow. So if you start to think about a company growing 40 or 50%, that's their minimum cost of equity capital. And then that's
Right.
before revenue multiple expansion. So it's very expensive.
And so how do you think about expansion? And if you were to sort of put this in like third grader language for me, like how would you define it and how do you actually see that show up?
In terms of revenue multiple expansion, like where is enterprise value created?
Yeah. Is that because you're bringing in the capital to accelerate and that's where you're seeing expansion? Or is it because they're building more fundamentals with that capital that enhance the quality of the earnings or the revenue? What sort of drives that leap typically that
Yeah,
you
I
see?
mean, a lot of the times in venture, you're trying to pull forward the future earning potential and bring it back to the present to get to a valuation. Like a
Right.
company today that's only generating 5 million of revenue, it's not being valued at 100 million because of revenue today. It's being valued because of the potential of the overall enterprise in the future and then discount it back
Yeah.
to today. So an investor will look at that business fundamentals and they'll look at things like their growth rate. It'll look at the health of their customer base. They'll look at the total market size. We'll dig into the team. So does this team actually have the ability to go out, continue that growth momentum, to continue to capture more share, to expand from this market into another market? Those are all the things that we think about when we're trying to think about, okay, is this a company that's really going to get a really high return on capital for themselves and for us as investors?
So you're taking a very similar lens. But as a founder, how do I think about working with you, Josh, as kind of like what's the tool that you're giving me that, let's say, alternative sources of capital are not? And one is, you're not taking equity. So this is inherently less expensive from an ownership perspective. You're giving me an option and
Right.
more optionality because I own more of the business. What else is this really good for?
Yeah. So at Flow Capital, we're venture debt providers. And the reason we caveat that with venture and debt is you don't think of us as a bank and don't think of us as equity. We're somewhere in between. So we work with venture level companies that are growing, making investments. As I mentioned before,
Yeah.
they're not yet cash flow positive because they're looking to continue to invest in growth. And
Yeah.
what we give them is we lend them money. So we give them money to go and invest in company, get a return on that, increase their enterprise value, and then they pay us back in 2, 3, or sometimes longer than
2 to 3 years. Okay. Yeah. That's what I was curious about, just for what's the length of that typical term, but sometimes
that.
longer, you had
Yeah,
mentioned.
sometimes longer. If it makes sense for a company to continue to maintain with us or to take more capital from us, we have the capabilities to extend with them beyond the 2 or 3 year term. Typically, what we find at the stage company that we work with, most of our borrowers are in the 2 to 10 million revenue, still working towards cash flow positive. We're helping them get through that early growth inflection point. So they're trying to get their company from maybe they're at a 20, 30, $40 million valuation when we come in, and they're going to try to double or triple that in the next 2 to 3 years. And they're going to have optionality in terms of their next level of growth capital, an
Yeah.
exit, and all of those are ways that we get repaid. We typically get repaid through a lower cost lender like a bank or as part of the next round of equity proceeds, whether that's growth capital from private equity or strategic or a full M&A event.
So I really, really think founders need to understand that there's more than just venture that they can access. There's more than just purely bank debt. Like, this is a very interesting space in between. And so if you have the desire to continue to preserve your ownership, but you've hit a certain level of traction where you're very attractive to Flow, for example, to yourself, Josh, it's a very interesting opportunity. Now, I'm curious, when you see this sort of seed strapping kind of piece and then, see folks come through, are there any blind spots or common mistakes that you see in companies that try to do this and fail?
Yeah, absolutely. I mean, we have a really high bar for the companies we work with, and there's a pretty strong reason for that. I mean, debt is also commonly referred to as leverage, and leverage works both ways. It's a really powerful tool. So it accelerates when things are good, but it also puts a lot of pressure when systems are not as strong or ready to
And
support that level of capital.
covenants
So
need to be
certain things like covenants.
met.
So there are certain things like covenants, but fundamentally the debt puts pressure on systems before the covenants. The covenants are a way to track a company's performance. But what we look for even before we get to funding or signed term sheet is the fundamental systems. And a lot of that shows up in the financial management of the company. So do they have a solid financial picture, rear view picture? So do they really understand how they got here, what their unit economics look like, how they actually track their revenue and billing? And then we're also keenly focused on how they think about the future. So their forecasts, we want to understand things like how do they build up their revenue forecast? Do they have a really good understanding of their cost base? And how much capital do they really need in order to get to that sustainably cash flow positive place?
Let's talk
So
about this.
all
I
that is
literally
really good for us.
critical. And the interesting thing is, and I see patterns across because we're talking to folks who are kind of ready to sell. They've been preparing their data rooms, full liquidity events, some who are in like growth equity raises, like across the spectrum. But what I hear is to be ready for a buyer, you also need to be in the same exact mindset to be ready for a lender. It's the same sort of principles, I imagine. You're looking at the business. How attractive is this looking backwards? How much can I trust that we can sustain these continued results all the way? First of all, do I trust the historicals? Whole
That's right.
other can of worms. But I was talking to a CFO the other day and she's come on the podcast. She's fractional. And we were talking about the difference between there's a lot of CFOs who have the title and the finance function within a company, but they typically had come from audit. Like they've come from one of the big firms. They've really been great at looking backwards, but they're not necessarily a CFO that you really would expect, which is more of that strategic thinking partner, build me my decision set from a financial perspective, more of that forward-looking person. So I'm curious, do you see companies coming to you with a level of sophistication around like beyond 12-month planning, that forward-looking capability? Is that a weak muscle that you're seeing or
That's our
strong?
number one. That's the number one breakdown for us in our process. I met with
Interesting.
literally thousands of companies at this point, specifically in my role here at Flow. And I can't tell you how many calls I get off with the founder and on paper or on Zoom, however you want to picture it, seems like a good fit. And then we open up the data room and there's just such a far gap between what they feel like is a forecast and their ability to tell their story financially and what we're looking for as a venture debt provider. I think sometimes companies mistake raising venture debt as being lumped into raising venture equity. So we'll get these forecasts with them, which show huge hockey stick growth. And then we take one level down and it's like, well, okay, we have a, a sales rep led motion and we're going to triple our growth. So we have simple questions like, well, how many people do you have on your sales team? And they're like, well, it's just the founders leading sales right now. So, they don't even have the fundamental pieces of their forecast understood from a strategic buildup for us to have the credibility that they're going to be able to achieve anywhere near what they think they can.
That level of detail and outbound is very expensive as an example, and really understanding the unit economics of that. Like, how long is your sales cycle? What is your expected velocity? How many are you actually going to close? Do you have a pod? Do you have like a BDR and ISR? Like, what's the setup? There's so much detail in it. And I do think founders struggle because we're so close to it. We're so in it. There's really, if you break down businesses, you see tons of companies, tons of patterns. If you break down what drives growth, do you think you could boil it down to like 2 to 3 things for each company they need to nail to get it right? Like, I think we tend to overcomplicate these things when really, I think we need to understand the fundamentals, right?
Yeah. I mean, when we kind of look through the things that we focus on, there are 3 things that we at a high level focus on. So the first is we want to feel reasonably confident they have product market fit. Most of our borrowers, a lot of that is retention. So are their customers not only continuing to buy, but looking to buy more? Your customers tell you the story, right? So that's really important. The second is on that go-to-market side. Do they have maturity in their go-to-market in terms of really clearly being able to articulate who their ideal customer is, but then also how they find them and how they win them? So if they go to market through direct sales, do they have enough sales reps to meet the quota in order to get to their target? If they have a partnership channel, how many partners do they have? How effective have those partners been at, expanding and helping them to hit their numbers? If they use a product like growth, these are the things that we really want to get into in terms of actually how do they grow their top line. And then we already talked about the third one is just, we're really trying to nail in, not only does their financial model look good, we want to see full 3 statements, P&L, balance sheet, cash flow statement, but we also want to see that next level of the unit economics. So do they understand how much does it cost them to acquire a customer? How long do they typically say, are they gross margin, like contribution margin profitable? Because we see businesses that think that they have a good product, but they don't realize they're actually costing them money every time they sell. So these are things that are really important for companies to understand before they start entertaining venture debt.
Let's dive into that just for a moment and the contribution margin conversation. So I've seen founders across the board, and when you're looking to sell VC, the 3 to 1 is kind of the golden rule of, your lifetime value, which is the revenue you earn over the life, however long they stay with you. Usually it's like 3 years, dream scenario, to the cost it for that individual. So that's the unit economics we're talking about.
Yeah.
But a lot of founders aren't fully loading their costs.
Right. That's right.
Which I see a lot. And so do you see this a lot? Is this it's a bit of a vanity metric otherwise.
We see a presentation with 7-to-1 LTV to CAC, but then that is their
Stiff
gross
test.
revenue. And then they don't layer in that they actually have a gross net margin because they have a distribution partner. So that what actually hits their P&L and their net is even lower than, so that 7 drops to 5. But then what's really important is your contribution margin, LTV to CAC. What's the lifetime value of your contribution margin? Because it's very different if you have $100 of revenue and you make 80% margin on it versus 20. So understanding those components is very critical for really diving into CAC.
And I would say founders, if you're not fully loading your CAC and looking at your unit economics on a per channel basis, you're not able to make decisions on where you should continue to reallocate and change, right? And I think it's so important. I think we're almost afraid to look at this stuff when really like we should just shake it out and be like, where is it? Because someone like yourself or a future buyer is going to start asking those questions, and you would rather be in a position of strength, which is what we are stoked about.
And we as venture lenders, we understand we live up the risk curve. So there are certain risks that we can live with and understand. And actually our model is even, another important, unit that you would look at or metric you want to understand is CAC payback. So not just how much does it
Yeah.
cost you, but when you look at your margin and how often your customers are paying, how long does it actually take you to recover what it costs you to spend? So in
Yeah.
certain types of financing, it doesn't necessarily make sense to use debt if your CAC payback is going to be 2 to 3 years. But if you feel like your LTV is high enough, it may make sense. So
Right.
but you need to be able to really understand that so you can sell the story and you can find the right financing partner who wants to go into that. So like, a growth capital equity provider might have a lot more latitude to say, yeah, we're okay with a really long CAC payback because we see the really, really high LTV on the back end.
Ooh, so that's really
Or we can
interesting.
layer you into another portfolio company, or we have the right introductions to another channel and we can shorten that payback through upsell with some of
That's
the portfolio companies.
This is why knowing your unit economics, what it actually on an individual customer level is so powerful because it unlocks how you should think about capital and where you need to use that as a tool and who the right partner is for you. Because to your point, you're only
Yeah.
there 2 to 3 years. That may not make sense versus someone who has more of that longer tail kind of permanent view. Not all of them, especially growth
Yeah.
equity, has like a window, but they're typically
Right.
longer than a 3-year window.
It gives you really strategic understanding of like, okay, maybe I have too many products. Maybe I'm trying to sell too many things to too many different types of customers. And I need to focus
Yes,
because I only have so much capital available. That might be a really great product that's solving a lot of problems for our end customers, but we can't sell it efficiently. So we need to
that
move on.
is
Actually works for us at this stage of our company life cycle.
such a great call out. So let's talk about what you sort of have a point of view on this. I know, Josh, but around how pure software founders may not be thinking about this, but you've talked about how services and hardware kind of start to become more real retention moats as AI starts to really commoditize software. And I've seen this as well. I've seen a lot of venture studios who are going, you know what, we're going to start as a services company and then we're going to lock in and build the platform around it because it's harder. Really, and I know this having led services, it's very difficult. But back when I was raising money, if I had a services component, it was like, oh, that's not scalable. That's not
Yeah.
interesting. So I'm curious, are things flipping? What are you seeing related to services and software coming together?
Yeah. I mean, that's not wrong. Like there is some scalability issues with service businesses. However, AI is allowing you to effectively get a lot more leverage on the service components of your workforce. So if it's all
Right.
knowledge base and you have to think about like, look at the consulting business. I know you came from consulting, so you know that all
Yeah.
too well. How many hours did you spend putting together PowerPoints and models? A lot of that is going to come down substantially. So you could focus on really the strategic work that your customers and clients would have been hiring you for. So a lot
Totally.
of that is changing. I think people want hand holding these days on some of, their products, not just being expected to go and take it themselves. And with hardware, we're seeing that as a really good mode. I mean, it is a hard business to manage. You got to manage supply chains. You have to manage increasingly tariffs these days. But once you've made the investment in the hardware, it's pretty sticky. So there can be some advantages of that business model as well.
Oh, I love that. Now, I think one question for you, one of the things we talked about was just sort of the headline of, sell my company for 200 million, but, there's deal structure, of course. How much equity does the actual founder have? What is the deal structure in terms of how much of that is cash versus earnout? For founders listening, why would it make sense for them to come to you in that scenario as they're thinking about, hey, I want to work towards a strategic sale over the next 3 to 5 years. I've got an asset. I know I can spin this up. I want to accelerate it. What are they not maybe thinking about blind spots related to the path to that strategic exit?
Yeah, I mean, there's a number of things to consider here. I mean, just fundamentally, if you think about a $20 million exit versus a 200, you have to understand who's on the cap table and what their kind of return waterfall is. So in many cases, if you raise from venture capital, you might have things like a liquidity preference that may be participating and not participating. So they get paid and get the return of their capital before the common shareholders, which is the founders. Other things to consider too are, not just necessarily the dollars and cents. Like, let's say you're a 5 million revenue business and you want to sell your business in 2 years and you think, okay, I need $3 million to really double in value. You may not be able to find an equity investor who wants to write a $3 million check for less than 20% of the company or 30% of the
Right.
company. So it's important to understand what it is that you need and who the end capital provider is in terms of doing though. There's other things to consider too. Like if they're going to write that big of a check, they're probably going to want to be on your board. They're going to want to have a say. If it comes from venture capital, the return expectations for venture capital are a lot higher than maybe someone from a family office or certainly from venture debt. So understanding all of those components are really important as you work towards your own exit timeline.
Here's my question, last question to you. And also, I raised through a family office and it was a phenomenal experience. It's a completely different experience and one that was more patient, I would say, in terms of capital. So knowing the capital landscape, know the capital game you're playing, know whether you need to raise money. Here's my last question. Is capital abundant still, even in this time? And secondly, should every business, what makes a business one that requires outside capital versus continuing to bootstrap? What is sort of that decision set?
Yeah, capital is abundant. There's tons of people looking to deploy. I think, it's going into certain pockets and everything goes in waves. There's a lot of venture dollars, they said record year in venture last year, but most of that money went to like the top 7 companies in raising venture dollars. So, but there's lots of great capital providers out there looking to deploy capital, but the bar has gone up a lot, specifically at the growth rate. Risk profiles have come down. The whole market shifted, in 2022 when rates went up for the first time in 10 years, which we coming out of undergrad in, 2010, 2011, hadn't really seen a world like that.
No.
But, when money stopped being free, return expectations changed quite a bit. So that made it harder to access capital, but it is still there. And then, why? It's speed. It really comes down to speed. We meet lots of great bootstrap founders and the conversations saying we can get there. We're running near profitable. We're pretty sure we can do XYZ. We can make the hires we need. But if we want to do it now, we need money to do so. And they're willing to pull forward some of that today and give it up. There's a cost of capital, whether it comes from debt or from equity. They're willing to pay the cost in order to accelerate and hopefully, take a little bit more of a bigger pie, even if it means a smaller slice.
It's a really good framing. And especially if you're in a space where you do need first mover or second fast follower kind of advantage, especially in tech when things can be built so quickly. That's a really helpful perspective. Well, thank you so much, Josh. Where can people find you? Where's the best place to reach out if they are a founder listening and thinking, I need to talk to Josh?
You can check me out. I post daily on LinkedIn. So just look me up, Josh Axel on LinkedIn. I'm posting lots of stuff about venture debt and AI. You can reach us at flowcap.com or my email is josh@flowcap.com.
Awesome. Thanks, Josh.
Thank you.